In 1890, the Bank of England faced a choice. Let a 200-year-old institution collapse, or break every rule they'd written. Most people tell the story this way. A reckless London bank called Baring Brothers gambled too much on Argentine railways and land. When Argentina's economy seized up, Baring couldn't meet its obligations. The bank ran out of cash. It should have failed. Simple story. Moral clear. Except that's not what happened, or rather, it's not why it happened. Baring Brothers was founded in 1762. By 1890, it wasn't just a bank, it was the asterisk bank. The firm financed wars. It handled government bonds. It moved the money that moved empires. When you picture a Victorian London merchant bank, you're picturing Baring. This is the institution we're talking about. In the 1880s, Argentina was hot. The country was modernizing fast. New railways, new cities, new government loans. London's banking houses saw an opportunity, and they poured capital into Argentine projects like water into sand. Baring led the charge. By the late 1880s, the firm had lent something like £20 million into Argentina. That's roughly $2 billion in modern money. Enormous exposure. Here's the thing about lending to Argentina in that era. The country's government was spending faster than it earned. The currency weakened. Prices rose. Projects stalled. By 1889, the house of cards was tilting, and Baring, with its massive Argentine portfolio, was tilting with it. In November 1890, word leaked. Baring couldn't cover its Argentine losses. The bank was technically insolvent. Panic spread through London like a fever. If Baring fell, what did that mean for the other banks holding Argentine paper? What about the firms that had lent to Baring itself? The math got terrifying very fast. This is where the accepted story says the Bank of England stepped in as lender of last resort. Noble central bank rescues a fallen institution. Systemic stability preserved. Order restored. Crisis averted. You've heard it. It's tidy. It's wrong. The truth is messier and more revealing. The Bank of England's governor at the time was William Lidderdale. He understood something crucial. If Baring collapsed, the entire London financial system could unravel. Not just Baring's creditors would suffer. Every bank that had relationships with Baring, every firm holding its paper, every depositor who trusted the system, all of it was at risk. So Lidderdale did something extraordinary. He didn't just lend to Baring, he organized a consortium. He called in favors from other London banks, Rothschild, Glyn Mills, and others. Together, they created a lifeboat. They pooled resources. They guaranteed Baring's liabilities. It was a coordinated rescue, not a solo intervention. But here's what most histories skip. Lidderdale didn't do this out of pure altruism. He did it because he understood the architecture of credit. He knew that in a system where banks lend to each other, where trust is currency, a single domino could topple the whole structure. Baring wasn't saved because it was special. It was saved because letting it fail was too expensive. The rescue worked. By early 1891, the panic had subsided. Baring survived, though it took years to rebuild its reputation. The consortium unwound. The system held. But something fundamental had shifted in how London's financial elite understood their own vulnerability. What the Baring crisis actually reveals isn't a simple story about bad lending. It's a story about systemic interdependence. Banks aren't isolated islands. They are nodes in a network. When one node fails, the shock travels through the system. Risk doesn't stay where you put it. It spreads. And here's the small irony that gets me every time. The Bank of England, which had been built on the principle of asterisk, not asterisk, bailing out failing institutions, the doctrine that bad banks should fail to encourage discipline, abandoned that doctrine the moment the alternative was worse. rules bent, precedent broken, all to prevent collapse. This pattern, where institutions break their own rules under pressure, shows up again and again in financial history. 2008 wasn't the first time the rules changed mid-game. It was just the most recent and visible. The bearing crisis shows us the template. The deeper lesson: credit systems only work if everyone believes they work. The moment belief cracks, the math falls apart. Lidderdale understood this. He didn't rescue bearing because bearing was solvent. He rescued it because solvency itself depends on confidence. You restore confidence by acting decisively, by pooling resources, by making it clear the system won't be allowed to fail. That insight, that sometimes you have to break the rules to save the system those rules are supposed to protect, is uncomfortable. It's also how finance actually works. Not how it's supposed to work, how it actually works. Understanding the difference between those two things is the difference between thinking you understand banking and actually understanding it. The bearing crisis didn't change the system. It just revealed how the system actually operated under pressure. And once you see how it works, you start seeing the same patterns everywhere. In every crisis, every panic, every moment when the rules suddenly become flexible. That's what makes this history so valuable. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how lending systems actually work, not how they're supposed to work, subscribe. We dig into these stories every week. Subscribe, there's a new unsolved case in financial history every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.